Jim, I'm super excited for this week's episode of the Silicon Valley podcast. Now, we've just recently met, but it's so fascinating what you're doing that, well, our audience really needs to know, especially here in Silicon Valley. I mean, the topics that we're going to cover today is information that, well, should come up more and more in conversation. But, I think I gave a little bit, enough hints to our audience to really captivate them. But before going into those golden nuggets, Jim, can you tell us a little bit about yourself, your career, and kind of the history of Riverside Acceleration Capital?
Thank you. Yes, would love to. Thank you so much for having me on the show. Riverside Acceleration Capital, RAC, we call it RAC, was really the culmination for me of a whole lot of observations, just a whole lot of time that I've spent investing in private software companies. This is what I love doing. I made my first software investment actually in 2006, and SaaS was still pretty new at that point, really. And it's been an awesome place to make a career. And so we had the chance back in 2016, actually, to get RAC going. And it was really founded on two core beliefs. One is really an observation that the software companies that have been most successful in my experience have been the ones that have managed to be really smart about when they raise capital, how much capital they raise, and what kind of capital they're raising. It's a little bit counterintuitive, but it makes a huge difference. And the flip side of it is that the companies that get it wrong, like, it can really screw up a company. And the second really founding belief is that I want management teams, founders, to really expect a lot from their capital partners. Meaning that if someone's going to make an investment in your company, they need to have real systematic operating resources that they can bring to you. It can't just be about who's the partner that's going to be on my board. That's important. But a firm needs to have real operating heft as well. You really need both parts of that equation. So with RAC, what we did is we kind of took a clean sheet of paper and said, if we were going to start a firm from scratch, what would that look like? And that's how we were born. So two things to know about RAC. One is that we can invest either debt or equity. We work with a company. When we meet them, we tailor it to what makes the most sense for them at a particular time. And then the second is that we live inside of a global private equity firm called Riverside. And Riverside's been around for 35 years, got offices all over the world. And that's where we get our operating capabilities. You can imagine that being a part of this big firm, companies that we invest in have access to just a whole range of resources. So that's really what it was. It really kind of grew out of those two core beliefs.
Now, Jim, you mentioned two things there that really caught my attention. The first one was timing your funding on the equity rounds. I mean, I'd really want to dive deeper into that. Also, you talked about, why should companies think of raising debt? Now, here in Silicon Valley, debt, I'm not sure if people even have ever heard of that word. So I'm really curious if we could dive into, and get some industry expertise on, well, one, timing around fundraising rounds, and then two, raising debt and not just equity, or maybe debt and equity, or the combination, a lot there to unravel, but wherever you want to take it.
Well, the first thing I want people to question is the whole idea that, like, you're right, there is this bias that the only way to grow and scale a software company is with an ever increasing series of equity rounds. Like, sometimes equity is great and exactly what you want to do, but sometimes it's better to look at alternatives, or it's better even to wait. And maybe I'll just take a minute on this. So the way that we think about it is, we think of software companies as kind of being on a little journey. It's like a journey that kind of repeats itself as they grow. And it's four basic stages. The first stage is where you're trying to identify what your pain is that you're solving. So really, like people call it product market fit. That's stage one. Stage two is then you're systematizing that and you're making that something that's repeatable. Stage three then you hire people, you really scale up. Like that's the big inflection point. And then stage 4, you take that and maybe you expand into new markets or some kind of a new channel. And then it starts over again, right? With phase 1 and perfecting that. And so to me, the kind of capital that a company wants to raise is going to depend on where they are in that journey. So if they're in like stage 1 and stage 2, if you're refining the product market fit and getting it repeatable, like debt can be a fantastic tool for that, because it allows you to make targeted investments. It allows you to make a few key hires and give yourself that confidence that you're ready to really scale up. And then in the meantime, your company valuation is growing. And then when you're comfortably at stage 3, you're ready to hire people. That's when equity really shines. That's the inflection point. Or if you're going in a new market, that's where equity really shines. That's an inflection point. I think like where people get it wrong is they try to raise equity too early when they're not quite ready. And then there's like pressure to like really hire up before the business is really ready for it.
I guess a question there with debt. I mean, one thing that founders here always talk about is, no one will lend me money. No one, banks won't touch me. Where are these debt options? And I mean, don't they have to have sales first before anyone will make a loan, or are there all these different types of debt options out there that people have no idea about?
It's more available than many people think. I think a lot of people just don't think about it. But you do bring up an important point that I don't think that debt is always a good idea. So like there are times when a company is too early, like when they're very early, less than $1 million, $2 million of ARR, it's possible, but in my mind, not an ideal time to be raising debt. I think it's more appropriate when companies have a little bit more scale, a little bit more stability, because that's the time where those targeted investments are really going to make a difference. The other time that I don't think debt is maybe the best is if companies are already investing very heavily in growth. Like if you already have quite a high burn rate, I as a founder, I'd be cautious, because you don't want a high burn rate and plus debt and a short runway can be a little bit precarious.
Okay. Yeah, we might have to revisit that later on, but I'm kind of curious. Can we go back to, so you're saying that people should be very careful for the timing of their equity rounds, correct?
That's exactly right. That's exactly right. Like it's almost like there's like an analogy that one of our CEOs gave us, where it's like you're running a company. It's like you're driving a car, and you're in the driver's seat, and then the equity, it's like the VC gets in the passenger seat, and it's like in a movie they bang your foot down on the gas and the car just kind of goes. And so it's very easy to end up, whatever, like in a ditch or in a hill or something. So you just want to be really careful before you raise that equity round, that know exactly how you're going to use it. And by the way, this is nothing against equity. Rec makes equity investments too. I just want people to be smart and really think about how they time it.
Okay. So let's talk a little bit about, I mean, either the thought pattern of that founder. So say early stage company, we're here in Silicon Valley. They're going through an accelerator. They don't really have the million ARR, annual recurring revenue. They do have some sales. So probably in that situation, they're limited to equity or friends and family round or that. But I mean, how would that timing? Because most conversations are, if we don't get money today, we're broke and we're sleeping on our, someone's couch, or heavens forbid they have to go back and work at Google and make 400,000 a year. Heavens forbid that. But it's not as far off as people think. Trust me, this joke is pretty realistic. But
Yep.
But with that, I mean, how could they do timing in that? Or should they be thinking about maybe the milestones they need to immediately hit? Or, I mean, situations like that where it's okay, we got 6 months to go, but we're still so early. What should they be thinking there?
I think that could be hard. I think that in the early stages, I agree with you. I think that friends and family, convertible notes, those are the most, or seed equity rounds. I think you really need that for a company to get a certain amount of escape velocity. Like growth oriented debt is best when you that product market fit, you're kind of coming in on it, and you have a sales machine and you want to perfect it. Like you want to get a sales machine, you want to get it repeatable, so that you have the confidence of a dollar invested in sales and marketing is going to result in X dollars of new sales. And the reason debt's so great with that is that you can make these very targeted investments. You can take a couple of quarters, hire a couple of salespeople, and see how quickly they ramp. Execute some marketing activities and see how well they convert. Really hone in on those unit economics, and then when you have that confidence, that's when you come in with the equity round and really scale up. And actually, one other case where debt can be a great tool is, and we have a lot of companies work with us for this reason, that as a software company, there are certain milestones where getting equity at attractive valuations can become a lot easier. So it's right, like 3 million of ARR, 5 million of ARR, 10 million of ARR, or like certain growth rates where valuations on equity rounds tend to go up by step functions. And a lot of companies work with us, and I think debt in general is a way to be able to accelerate themselves to those milestones, so that when they raise the equity, it's at more attractive valuations at that point.
Wait, Jim, quick question. The valuation bumps there, 3 million, 5 million, all associated with ARR or growth. Can you maybe go a little bit deeper on possible what those growth rates could be? Or maybe, I mean, from your side of the table, looking, what really piques your interest when you hear of a company doing this or doing that? Or what milestones maybe are industry milestones where it's pretty well known across the board in private equity, and that if companies hit this milestone, we're interested, or this milestone, we're interested?
Well, it's hard to speak in generalities. Obviously, every company is different, but in general, what I've found is that though there are a few big ones where when you hit these particular milestones, a new group of capital providers can start to talk to you. And I think that's why it flows down when we're talking about equity. It flows into higher valuations. And when you're talking about debt, it just means there are more options. Those that I've seen have been at around the 3 million of ARR mark. A whole new group of, you get into the universe of a whole new group of investment funds. Same with 5 million of ARR and 10 million of ARR. Like they're arbitrary numbers, but for whatever reason, it just does seem to make a difference. And growth rates similarly. I mean, like there's a huge difference between positive growth and negative growth. Results in very different set of options. But in terms of debt, I think there are people that will look at a whole spectrum. It just depends on what you're looking for and who the partner is.
That's really interesting what was said about how different milestones will open up more options for debt. And then, but for equity, will give those multiple bumps. That's
Yeah.
a really interesting way to think about it. That, yeah, I'm not sure if I've heard that before. But what I have heard in the past is people talking about like this debt spiral, that you get in debt and then you get, borrow debt to pay off that debt, and it gets worse and worse and worse. When can debt be, what should people watch out for?
Yeah, you do have to be very careful about that. And you're right. I think that debt at its best as a tool is something that can help give you confidence for that equity round, or can get you to those milestones where the equity round is going to go more smoothly and is going to be at a better valuation. For us, I like that we have this ability to do both. Normally in the industry, it's firms are one or the other. I think that where I've seen companies get in trouble with debt, I think where people have to be really careful is not to take too much. Where we usually think is a safe amount is taking a company's ARR, dividing it by maybe a half or a third. Tends to be comfortable. If a company is taking on debt that's like equal to their, 100% of their ARR or more, some companies do it. It works out fine. For me, it feels like a lot. And then the other situation where I think companies have to be very careful is if their burn rate is very high. Like we normally like to think that if we're going to make a debt investment in a company, they're going to have at least a year of runway before they need to start thinking about whatever that next capital event is, whether that's us leading an equity round or them going out doing an outside equity round or doing more debt, something like that. 12 months feels about comfortable. If someone is bringing on debt to cover 3 or 6 months of burn and then something else is going to have to get figured out, that can be a pretty short time frame. And maybe one other thing I'll mention that I think is really important is actually two things. One is companies need to be very conscious of how much time they're going to have to pay back the debt. Ours are set up over 5 years. I've seen debt structures where it's getting paid back in 1, 2, 3 years. And companies should just be aware that's not a lot of time to be able to use that money before you have to really start paying it back. Like it's best when you can use the debt, make some investments, really get the return before you're having to pay back the bulk of it.
And I'm wondering, and this I probably should have brought up, at the very, very, very beginning, going back to, everyone here in Silicon Valley, so used to venture capitalists. Private equity, I'm not even sure if that's in people's vocab. What is the difference between private equity and venture capital?
Okay, so this is very interesting. So I think there's kind of some interesting history here. Like the fundamental difference is that in general, private equity is 100% owning a business versus venture capital, growth equity, where you're a minority investor. But it flows through to what it's like to work with one or the other. So like, if you look at historically venture capital, a lot of the most successful firms were the firms that were able to have access to the best companies, really were the best company pickers. And that created a halo effect where they then had access to the best deal flow. And it was kind of a self-reinforcing cycle. I think that's changing in recent years. I think that venture firms have become a lot more active, but I think most people would agree with me that that's kind of where it came from. And you contrast that with private equity, where historically they've been investing in companies where they're owning them. And the most successful private equity firms were the ones that could take a company, get the growth going faster, make them more efficient, be like very operationally intensive. That's what I like about it. That's what I think private equity has really gotten right, is just the operating chops. And that's kind of what I mentioned at the beginning, that's kind of what we're trying to channel, is taking that private equity heritage and applying it to the investment that we're making, whether or not it's debt or equity.
Staying on that topic a little bit about the operations. I mean, here in Silicon Valley, we often hear smart money versus dumb money. And the smart money is, okay, it's not only giving whatever the amount, but connections, introductions. Is that expected as well with private equity if you take money from a private equity group?
Yes. And to me, what's important is that the investor, whether it's private equity or venture capital or debt or whatever, it's important to have both sides of it. And I think that's what, again, I think that's what private equity's gotten so right. So like the way that we're set up, we have a team that works on making investments and is going to board meetings and networks and connections and thinking about capital allocation, those kinds of things. And we have a totally separate team. And this is kind of how most private equity firms work, and some venture firms too, but really this is where private equity came from. It's a whole separate team of people that all they're doing is like, these are people that came from industry, they've run companies. All they're doing is thinking about how to help companies grow and making sure they're getting the operational resources that they need. It's very different. Those two things are very different skill sets. And I think it's important to have both.
And then right now, I mean, Rack is inside a traditional private equity group. Why do that? Why not spin it out to, I don't know, guess kind of a standalone thing? Why keep it in this kind of, I'm not sure even the relationship. Is it like a parent kid relationship? Is it like an umbrella? Like, what is it?
That's right. We're one of we are a fund of Riverside. So Riverside is our parent. And the beauty of that is that we have the ability to leverage that scale. So Riverside has offices all over the world. If we have companies that are thinking about expanding internationally, we have those access to those operating people that have been inside of industry. When we're investing in a company, there's a good chance that Riverside at some point in its 30 years has owned a company in that industry. There's a lot of expertise in-house. It's just a lot of scale that would be hard to have if we weren't part of this bigger organization. And I'm talking a lot about Rack, but really the bigger point I want to make is a more general one, is that I think that that's our particular model, but I think whoever a company is working with, they should expect that. I always tell CEOs when they're thinking about working with a firm, if the partner who is going on your board were to leave for whatever reason, would that firm still have some systematic way that they could be helping you from an operational standpoint? That to me is the key question.
Okay, now you mentioned board. Now, I also know that you have a lot of experience on being on boards, and that is something that comes up quite a bit with, because who knows, you get the wrong board, or maybe it's the right board still, but they can vote you out. If you're the CEO and you founded that company, one day things are going great, next day, and we had Jotham, a lawyer here in Silicon Valley, talk about stories, made up names of people that had 80% of the shares in a company, but the board voted them out. So how, from your position as on the board, advice, how should you be a good person on the board? What should founders think of when assigning board seats, or on the other side, the investors who from their team goes on the board? I mean, right there, I think we could talk for a day on it, but let's just start with best board practices.
Well, I mean, this is such, I think about this a lot. I love this topic. And you're right. I do have, I think, somewhat of a unique perspective just because we're involved with so many boards. As far as I can tell, it seems to me that board meetings tend to end up in like one of three categories. One is like the team comes and does updates, and the board is just totally disengaged, and nobody asks any questions. And it's just like a dead room, and those are the most painful, and it happens more than you would hope. And then there's kind of a second category, which I think is the most common, where they're fine, but it tends to go into a like board members with very strong opinions about smaller details, and those can get derailed, and inevitably you end up not having time to do much really strategic discussion. And then there's the third category where it's like really productive, and those are like those are the unicorns. They happen the least. I mean, it's like, it just kills me. It makes me so sad how often these board meetings are not great uses of people's time.
Well, with that, how to make them productive? How should the founder go into it? How should the board go into a meeting?
Ah. So I've thought a lot about this. I think that the most productive board meetings, I think you have to have the right, I think it needs like the right environment to thrive in, if that makes sense. Like, I think the conditions have to be right. And probably the most important condition is a feeling of safety and trust, so that there can be real honesty and candor. I think that it takes a lot of preparation. People need to be really, really prepared so that they can talk about what's important to the business. And then I think it takes a lot of time. I think that you need to have enough time, like unstructured time in the board meeting, for real strategic discussion. It doesn't happen very often. I think I'll say about boards the same thing I said about when you're looking at capital providers. I think it's an extreme privilege to be on the board of a company. And I think management team CEOs sometimes are too easy on their board. Like, I would love them to keep them to like very high standards. If you're having a board meeting and you're not coming out of it having thought about a problem in some new way, or having been challenged in a way that was meaningful to you, if you're not finding that you really care what the people on the board have to say, I think that's kind of on you as the CEO, you as the founder, to fix that. Like, make sure you're getting something out of this. Otherwise, well, really, what's the point?
And I'm sure it's case by case, but how much can the CEO in that push the board for either engagement from them, for advice? Like, when does it, from your experience, and maybe, because everything's confidential, maybe it's hypothetical what you've heard. When it's okay, this the CEO and that they're pushing us to get information, or hey, the CEO is pushing us, now it's time to replace the CEO?
I don't see CEOs getting replaced by boards very often at all. I know it happens when things start to go badly in a company. Crazy things start to happen. It's very, very unusual. I think that CEOs have a lot more influence than they think over how those board meetings are going to go. People are doing this. People on your board are doing it because they enjoy it. They want to be helpful. And if you're not setting up the right environment, if you're not creating the conditions where they can be helpful, it's just not going to happen. Okay, so I'll give you an example. Probably the most effective constructive board I'm involved with, the management updates are recorded in advance. And so the board, you watch the meetings ahead of time. Everybody comes, everybody's prepared, and then the entire meeting is oriented around unstructured discussion of what are the strategic topics that we need to talk about as a board. Like, that's super effective. And that's not something that it was driven by the board to do that. That's driven by the CEO. That's just one example.
That's really interesting. In fact, I hope our audience takes that advice and uses it. I mean, I'm not even sure that could be considered a hack, but I don't see why not everyone's doing it.
Right. Like, can you imagine how substantive those board meetings are? It's everybody's super prepared. It's a lot gets done and the CEO gets a ton out of it.
What about the very, very beginning, when the CEOs, first, or the founders first constructing their board? How should they be thinking about, 5 seats, 7 seats, 3, just the very foundation of it? And because I would guess the foundation, those decisions impact the future so much more than probably people are aware of.
That's probably true. To me, what matters the most, more than the number of seats, 3 feels like too few, 7 feels like too many. Most that I'm involved with are usually 5. 5 or 7. What matters the most is, does the CEO, like, do you care about what these people have to say? And I would like really encourage people to think deeply about that. I think that founders get, and rightly so, but get focused on when they're thinking about taking capital or whatever, they get focused on, it's like, oh, like the valuation, what's the difference in the valuation in these two things? Or like in the case of a lender, what's the difference of a few percentage points of interest here or there? Those things really are not, in the end, what's going to make the most substantive difference, in my opinion. Like, what's really going to matter is, are you getting involved with people that are going to be helpful, that are going to be able to help you, that are actually going to have things to say that you're going to care about?
Okay, now going back, we did discuss the difference between venture capital and private equity. But when should a founder reach out to private equity when considering raising capital?
Hmm. So the great thing about private equity is typically they have a lot of resources, and uh, and PE private equity firms are investing a lot more in tech now than they used to. And if you're looking for a war chest, um, that private equity can be great. Like, if you really want to go out and attack a market, hire fast, they have a lot of resources, can put a lot of capital behind you. I think that most typically that starts to happen in the world of enterprise software when companies are getting, like, have some scale, like when they're getting to 15, 20 million or so of ARR, then private equity firms can, in my experience, will start to get interested in doing some of these really bigger kind of hyper growth rounds. I think that'd be great. Of course, the drawback of that is that that the founder, the CEO, is signing up for quite a journey at that point. It's going to take a while to deploy. A war chest is going to take a while to deploy it. So it's not really an exit. It's really a CEO signing up for usually 3 to 5 more years of running the company.
What about that relationship between, I mean, normally goes angels to VCs, VCs to private equity. And
Mhm.
that angel VC, I mean, sometimes it's a love hate. I mean, you'll hear
Yeah.
stuff of angels making intros and then same time VCs kicking angels out. And what's the relationship between VC and private equity?
It's just much more common than it used to be. When I got started in this back in 2006, it was angels, VCs, and then either you sell to a strategic acquirer or you go public. We really didn't think about um, going to private equity firms at that time, and that's totally changed. Um, and so it's just, I think of it as another tool. It's another path. It's another path for founders to get liquidity and to grow their companies. The other time that private equity can be really useful actually is on the flip side, because they're so much more active now than they used to be, and doing a lot of these roll up strategies. It can be a great path actually if things aren't going great with the business. Maybe the growth has tailed off. Business hasn't gotten the scale that maybe people hoped, and people are looking for a new home. Those can sometimes not going to be done for the highest multiples in the world, but they can still be good outcomes. And I find that even like, it's something people don't think about, like even surprisingly small software companies with, in some cases, I've seen surprisingly low or even negative growth, can still find exits that can make people reasonably happy if they're talking to the right PE firms.
And it's also funny because you mentioned small. Small is relative. What's
Yes.
small in your guys' world?
Yeah, small in my world. So, and when I'm saying small, in my experience, if a company's at 2 or 3 million of ARR, I think it's possible for PE firms to potentially get interested in them. It happens even with companies that are like at $1 million or so. Below that, I'm sure it happens, but I just don't see it that often. There needs to be some kind of scale for the firm to want to like plug it into some other platform that they have.
And then I'm also kind of curious, where are you seeing the trends in private equity? I mean, Rack is kind of a unicorn on its own, but where overall in the whole ecosystem of private equity are things going? Are they going towards, competing at the lower end with VCs? Are they going to, I don't know, giving higher multiples or taking more risk, or what's happening in that world?
I think so. To me, what's most interesting is that there are now private equity firms that like all they do is invest in tech. So that's been a change. Like if you look 10, 15 years ago, it wasn't done that often. And now their whole firms is like literally all they do. The other thing that I think is interesting is that private equity firms are now talking to companies even before they're profitable. That's also not something that you saw very often in the past. So it's good. I mean, it's been great for as somebody who is in this space and working with software companies, like having this kind of whole new source of capital to help fuel the growth. It's been a nice tailwind for us actually.
Okay. And I'm sorry to put you on the spot here, but I gotta ask, a lot of our listeners in that they'll say, hey, I just got, an email from a private equity group. They're really interested in acquiring us. We're going to have a call next week. And you'll just hear these, unsolicited acquisition offers where someone gets really excited, but they won't talk about it later on. It sounds like it dies. Or, I mean, if a random company suddenly gets this email from a private equity group, I mean, I know each group is different, but how serious should they take those emails?
Well, I wouldn't. It's not something you can certainly bank until it's done. But I think I think it's a very difficult balance for CEOs because it can be a big distraction. I know that companies hear from private equity firms, investors, VC firms, growth equity firms all the time, and I think that a CEO could really spend a lot of time if they have every single conversation. But I also think every conversation you have, you learn something. And I've seen some of those where it was a cold outbound, like a cold inbound, turn into like something real. So I wouldn't be close to it. But I think you're right. It's like by its nature, just understand that these firms are super, super selective. They're looking for every investment they make, they're probably looking at 100 that they don't make.
Jim, before wrapping it up, I mean, can we go back to the topic of, how to be a good board member? I really want to dive deeper there because, I mean, it is something we don't talk about too much on the show, but it really does affect companies tremendously. So, I mean, how does one go about being a good board member?
Well, we talked about preparation, and I mean that's kind of obvious. I think everybody knows that you want to be prepared, you want to have a good network, all that stuff. I think that what's really important, I want people who are thinking about going on boards, is to think about the empathy side of it, and remember that it takes a lot of courage for somebody to start a software company or be a CEO of a software company. People work very, very hard. It's a, they're doing it because they want to make the world a better place. Like, I honestly feel like software has the ability to make the world a more efficient place, better place, more fair place. I mean, that's why I do this. I love being in this industry. And when you're on the board, that's the mindset of the leaders of these companies. And sometimes things don't go great. It just happens. And it can be for reasons that are outside of the control of anybody. And ironically, that's when the board should be stepping up the most. And what I've seen in my experience is that's when things can get the ugliest. And so I would just encourage people to have a lot of empathy for that and realize like how hard people are working. And when things aren't working, maybe I think even a small amount of acknowledgement of that can go really a long way.
That reminds me of some of our past episodes when we interviewed Chucky Orbita, the former center of the Pittsburgh Steelers when they won the Super Bowl, and he was talking about mental wellness. And also Sam Wong, we interviewed him. I think it was episode 101. He had 5 companies, 3 exits, 2 failed, but he was talking about mental wellness again during the tough times of almost losing his house and all these other things, and how there's these peaks and valleys of founding these companies.
Yeah.
But with that, the mental wellness and that question, do boards roles kind of change? I mean, I understand them changing when, there's ups and downs with the company, but what happens when there's ups and downs from like the outside economy pushing in on the company? I mean, should the board step up there? What changes from the board's kind of point of view or insight when there's all these outside things happening at once?
I don't think the board should be making those kinds of decisions on behalf of the company. I think it's very hard for the board because they're not there, they're not on the ground. I don't think it's healthy when people see an economy that might be weakening to make unilateral statements that, we need to let people go and get to profitability, and because it's going to depend by company. And I think the board needs to make sure that the founder of the team are focused on the right things. But it should really be a decision that's made collaboratively, and knowing that the CEO and the team have much better visibility being there on the ground than the board does from their vantage point.
Nice takeaway. I like that. Jim, if there's anything else you want to share with us, any key takeaways, please do so. If not, where else can people find out more information about yourself, Rack, and, all the little details about Rack?
All right. Well, key takeaways: be smart about what kind of capital you're raising, when you're raising it, and hold your financial partners to super, super high standards. Those are my 2 big things. If you want to get in touch with us, I'll just start with our parameters. Our debt investments, they start between $1 million and $3 million. And our equity investments usually start between 5 and 15 million. And our engagement model is that when we meet with a company, we get to know them, we work with them to decide which form of capital is best, depending on where they are at that particular moment in time. And either way, whether we're investing debt or equity, companies have access to all of our operating resources that we've been talking about today. We'll often actually stage it. So we'll start with a debt investment, and we'll work with a company on hitting some of those milestones, getting that sales machine in a repeatable place, and then we can make a very quick decision and lead an equity round. And companies know us; they know exactly who they're working with. So that's great when we can start with debt and grow into equity when that happens. So that's our model. And if you're a growing software company and you're between 2 and 15 million of ARR, and you're in the US or Canada or Europe, Australia, New Zealand, and if our philosophy, if everything we talked about resonates with you, then please reach out. You can go to our website at riverside.ac.
And if you're looking for someone to be in the middle of that conversation when I'm not host of the Silicon Valley podcast, I'm a mid-market investment banker focused on mergers, acquisition, growth capital. And with that, please reach out, connect with us on the Silicon Valley podcast, connect with myself on LinkedIn at Sean Flynn SV. That handsome bald guy there with that nice suit on, that's my picture on LinkedIn. But, more than anything, Jim, I want to thank you for your time this week on the Silicon Valley podcast. I look to have you on the show again in the future. And with that, thank you again for your time this week.
Thank you. It's been a lot of fun.